So a warm welcome everyone, and thank you for joining this Hardman Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's investment case and to question the management. Let me start to introduce the next company to present, which is Helios Underwriting. So this is the only listed investment company offering investors growth and returns from exposure to Lloyd's of London. We've all heard of Lloyd's of London, but it's quite difficult to invest in if you're, for example, a retail investor. So this is an AIM-listed investment company. It's got a market cap of 60 million and it offers growth and returns by building a portfolio of underwriting capacity at Lloyd's through the acquisition of some high-quality limited liability vehicles, as the guys are going to explain in a minute. The LLV structure replaced the famous Lloyd's name structure at the start of this century, and many of these vehicles are coming up for sale as their owners and founders age and decide they want to cash in their chips. We've got two speakers today. We've got Nigel Hambry, who's the Chief Executive of Helios, and we've got Arthur Manners, who is the Finance Director. Gentlemen, over to you.
Keith, thank you very much, and thank all the listeners for sparing the time. Can I just correct one thing? Our market cap's 110 million. Just to
apologise
for the record, but I think that's probably since we've had a couple of capital raises. But everything else, your introduction was extremely accurate and does it much better than I do. But as you said, I'm the CEO and Arthur is the FD. And together I've been in the market 40 years, Arthur's been in it 20. I was on the capital side throughout the last 40 years and Arthur on the underwriting side. So with any luck, in that combined 60 years, I hope that we have learned something. So before I get on and talk about who is Helios, I'm going to say just a few more words to add to Keith's explanation of Lloyd's and our place in it. It's a specialist subject of a huge number of people, but I'm going to keep this to about 1 minute. And basically, Lloyd's is the provider of insurance throughout the world on really difficult and complicated and specialist risks. We're probably not so good at insuring a house in a street or a shop front or whatever, or a motor car. But if it's difficult and complicated, then we should be on it. And so, for example, we will have exposure to that ship that got stuck in the Suez Canal, or we will have exposure to wildfires in California and the big freeze in the US, directors and officers, and of course, the sort of dreaded cyber. But those are the sort of things we do. And if you think about insurance for 1 minute, what we're doing is we're offering a promise. And if you're offering a promise, you need to be absolutely sure that the promise is delivered on when it's called on. So therefore, you need to have a lot of capital. And the capital is provided to Lloyd's through what I call first-party capital providers, like the Beasleys and the Hiscoxes and the AIGs and the Munichs and so forth. Straightforward insurance companies. And most of the brand names in the world will have some sort of involvement with Lloyd's. Or the capital is provided by third-party providers, chiefly private investors. And that's where we come in. We are one of the largest third-party providers of capital. And the difference between first party and third party is that we don't have people issuing policies, paying claims, managing a brand, setting up offices abroad and so forth. We are pure and simple. We like to get directly into underwriting risk without any flim-flam on the side. We are third-party providers to these experts like the Beasleys, Hiscox, and so forth. So now on to that first slide, which is who is Helios? Well, we are a leading consolidator of that third-party capital in Lloyd's, and there are thousands of them. And our universe is probably about 1,500 individuals who still trade at Lloyd's, down from a total of about 32,000 in its heyday back in the 90s. And these private individuals, private investors, they invested through ups and downs. And there was a moment when the World Trade Center event happened. And that followed quite a few years of very difficult underwriting conditions. And they made a very tough decision to stay in and continue underwriting in 2001 and onwards. And they've been amply rewarded by 16 years of profits. But what's happened is that they were probably in their 60s in 2001. They're now in their 80s. And the costs have risen and the hassle has risen. And many of them wish to sell their vehicles. Their vehicles, they started from scratch and generally, and now they are worth £1 or £2 million a piece. And as I said, our universe is about 1,500 of these vehicles. So we have bought quite a number of them already, and we consolidate them into and have created a diversified portfolio of insurance risk. And we are pretty picky, as you would expect from 40 years experience in the business. It is very important to go for absolute quality. So we've put together already a portfolio of the top performing syndicates through a listed company. And that portfolio has outperformed every year without exception. And anyone can outperform in a risk business in good years. You just take more risk until you don't outperform when the bad years come. So I'm particularly proud of our outperformance in the difficult years which we've recently had. And because of our size, we have available to us a flexible reinsurance program. And as we were growing over the last few years, we used that ability to buy reinsurance to its maximum. And we basically laid off, like a bookie on a race course, we laid off most of our risk. We didn't know COVID was coming. COVID is an insurable risk. We didn't know COVID was coming, but we knew times were difficult and we wished to lay off that risk, which we did. And it's been very effective in protecting us from COVID losses. So right now we're refocusing not refocusing, we are focusing our business on buying out more and more of these old investors' vehicles. And these vehicles contain some lovely syndicates and nice assets. But it is capital intensive, and we've had a couple of capital raises over the last few months, and we'll talk about more of that in a minute. But the effect has been to allow us to increase our risks very, very substantially, our exposure to underwriting at the right time. Now, this shows is a list of the major entities that we support. Some of them you will know about, like the likes of Beasley and Hiscox, and some you've probably never heard of at all. But these are quality outfits with quality renewal books of business. And we have a stake in each of them in varying sizes. They're substantial underwriting businesses. And for most of these participations, we have rights of ownership. They're called preemption rights. So when those syndicates, these entities wish to grow, they have to give us our share. And so we can't be diluted, we can't be selected against. These are very, very valuable ownership rights, which we have. And at the bottom of that slide, you see the outperformance, which I think is sometimes a little bit embarrassing, but it's delightful when we compare our results in Lloyd's through good and bad years.
Thanks, Nigel. So the insurance market is a cyclical market. It depends on the amount of capital that comes into the market. And since the market cycles last about 20 years, so it was in about 2001 that the prices rose substantially last. And they rose after the World Trade Center and after about 4 years of losses. So we've now just had 4 years of losses from underwriting years 17, 18, 19, and even maybe 20. There's going to be a marginal profit. And COVID has been the straw that broke the camel's back, and now the rates have been going up substantially. So the rates for the premiums that were written, or the risks that were written in 2018, the underwriters are now getting 30p per pound of risk than they were getting 4 years ago. So if they were breaking even on the underwriting in those years. If they're receiving another 30p, the prospects for underwriting profits are now substantially better. And the insurance cognoscenti, and we'll come to the people who have supplied us capital, sort of understand this. And they realize that with the additional money coming in, which they've got to pay the claims, they've got to pay their expenses, there are going to be better returns to shareholders. And we expect these rate increases to keep going in 2021 of about between 10 and 12%. And then after that, we expect those rates to flatten off, and then the rates will slowly decline over the next 5 or 10 years. So we do see sort of 5 to 10 year period of where we can achieve superior underwriting profitability. In terms of the lines of business that have shown the biggest rate increases, that is some of the US financial institutions have been charged a lot more money. The directors and officers insurance, particularly in the US, they're having rate rises in excess of 100%. And where there's been COVID exposures in terms of the employment practice liability and the medical malpractice, those rates are going up. There's not that there is, and this has been driven largely by a fear and a shortage of capital, and that will sort of start to reverse. And so this is the opportunity to move the business forward, and that is exactly what we're trying to do.
Thanks, Arthur. And I think that this is the sort of the business case. What is the business case for investing in Helios? And as Arthur has said, we are now in a hard market, and it continues to harden. And this is the 4th hard market in my 40 years. So I'm thoroughly enjoying it. In a hard market, you need to increase the amount of risk you retain on your books. And we have the ability to do that. Because of our size, we have available to us not just the reinsurance arrangements that I talked about earlier, but a whole range of tools. And the tools are most effective at either end of the cyclical market hardening or softening. So if it was a dire times and the rates were terrible and the claims were too much and so forth, then the tools available to us would be to buy stop loss. And we would emphasize on that. At the opposite end of the market, the tools available to us are gearing mechanisms. And of course, we are using those and our competitors don't have access to them or don't have access to them at the same terms as us. Similarly, many of the costs in our market are flat. You pay the same as writing £1 million as you do for £100 million. And so there are enormous benefits to size. And there's something else, which is not so much a monetary cost, but there's a hassle factor of running these vehicles. We're paid to do it, and that's what we do. That's our day job. But private investors find the regulatory regime has got so harsh now that they just throw in the towel. And those costs, they're not worth it for writing £1 million. So there is the LLVs available to us are clearly increasing. We also benefit because of our size and because of our quality spread from below average capital requirements. And the amount of money we have to put up to write £1 of business is about 48%. And a lot of other people are had to put up between 60 and 100%. So it's a very nice capital arbitrage, if you like. It's also quite timely as far as the tax environment is concerned for vendors of these vehicles. Now, I guess many of the listeners will be much more attuned to this than me, but on the whole, these vehicles are all capital gain. And we have a 20% capital gains tax rate, quite a favorable corporation tax rate currently for disposing of assets within the company. And in many cases, and in fact, most cases, they have the old entrepreneurs relief, now called BADR. So, and none of us know quite how long those rates will last. But so someone who is a bit nervous and a bit old might well say this is not a bad time to cash in. We have also reaffirmed our dividend policy, and we have been paying dividends. We had a small break with COVID, and we're now reaffirmed a 3p per share sustainable dividend, supplemented by special divvies as the profits come through from time to time. So an important point about insurance, again, people who manage investment portfolios, we do add a significant degree of diversification. Insurance risks march to a different tune to other cycles. And so Helios does provide this diversification. It's asset-backed, as I think Arthur's mentioned. We're dividend paying, and we provide this diversification. And finally, on this slide, I would say that point out that our shares are eligible for business property relief as far as IHT is concerned.
The company structure and our recent capital increase, as you say, we are an AIM-listed company. We've raised £75 million in the last 9 months in 2 capital raises. We have persuaded 3 substantial investment managers to participate in the company. As ILS Capital is Bermuda-based, Hudson Structured Capital in Bermuda, and the Polar Capital Insurance Fund. And the Polar Capital Insurance Fund, they have about 30 different holdings within their fund. So we were delighted that they understood the opportunity that the Lloyd's market now presents. So all 3 are specialist insurance funds, and believe that there is the prospect of building shareholder value over the next 5 years with this rate increase and with our participation in the better managed syndicates at Lloyd's. So the shares at 110 million, we know we've still got a bit of a hill to climb, but the shares have been re-rated, and there is now better liquidity in the shares than there was 12 months ago. And we see our key metric in managing or measuring the growth in shareholder value is our net asset value per share, and that currently is around 150p per share.
Thank you. So to finish, we have significant opportunities for growth now. The skill of a cyclical business is not to, and in an insurance market, you don't get a hard market without losses. The skill is not to lose your shirt during those losses, which we didn't. So we have raised the money. The money is intact. We have plenty of places to deploy it. The first, as we've described, is the acquisition of LLVs. We are in the midst of that now, and that's our number one concentration at the moment. We can also increase our retained capacity by reducing that reinsurance I told you about earlier. It's actually called a quota share reinsurance. That we have 47% of our portfolio is currently underwritten by others, and we can reduce that as we see fit. Then I mentioned earlier the rights that we have. Well, all those syndicates that we support, they see a great market, they see opportunities to write more and better business, and they will be growing their businesses and giving us our share. So we expect significant preemptions on these highly sought after syndicates that would cost an awful lot of money to get on, but we get them for free. These rights we get for free. And lastly, there is, in a hard market like now, when it turns, there are all sorts of businesses that are essentially first party, but they like third party support from people like us, in that we are, dare I say it, knowledgeable, but not competitive. We're not going to look at their books, see the classes of business they're in, and then go off and set up ourselves in competition. And people like to have a spread of capital support. It gives more power to management, and we like to provide our money in that way. So we're armed, we're ready to go. The pot of money is intact, and we think it's a really exciting time for us to be in this game. Thank you all very much. Delighted to take some questions.
Gentlemen, thank you very much. You'll not be surprised that a lot of questions are related to the experience of management is absolutely critical in a highly cyclical business. So would you like to explain what you've learned in previous cycles, and if the current cycle doesn't move as expected, what action can you take to mitigate risk?
Right. Well, I think the lessons that I've learned in 40 years of this business are seared into my brain through these varying cycles, but they do have certain common denominators. For example, anecdotally, when people start telling you the cycle is over, we're no longer cyclical, this is the new normal, you know you're getting close to the cycle turning. And you then listen to the likes of, I think, Warren Buffett, who says, or might have been a Rothschild years and years ago, saying you buy to the sound of gunfire and you sell to the sound of violins. So you've got to get over your fear and play again counter-cyclical. But as I said in my presentation, I think that we were very cautious, and rightly cautious, as we grew in a very difficult market. And so we did buy this quota share, which simply took away 70% of all our exposure. And the 30% that remained with us, we bought a stop loss on. So as we waltzed into COVID, we were not the least bit fast. We didn't know it was going to be COVID, but we knew there would be a loss of some description. And so when we raised money, we were not plugging a hole. The money was there to help us grow. So, and the second part of your question is, if it doesn't go according to plan, well, we'll have to respond when we see why it's not going according to plan. Every cycle is slightly different. And I won't bore the listeners with the fact that the reinsurance market is not going any as hard and as fast as it has in previous cycles, but the insurance market is there for all to see. And that many of the listeners will see it in the rates that they're being asked to pay for the D&O and E&O and other stuff that they are having to buy. And so we will respond to whatever comes our direction. But right now, the insurance market is hardening and has hardened and is continuing to harden in exactly the way I would expect. And I think in possibly a more mature way. In previous cycles, we have had lots of people going bust. We've put a naught on the end of the rates. Our reputation has not been well served. This is a much more mature hardening of rates, terms and conditions.
So over the next couple of years, let's just go over a couple of points. So there's a chance of increasing capacity. Would you be buying more LLVs at the expense of retentions, or would it possibly be the other way? And how flexible are you in that equation? This leads to another question about LLVs. Do you actually offer them shares, or is it always cash? And how do you value these businesses, and how many of them do you pass on, having had a look at them?
These LLVs, they have three main assets. They have the capacity rights, those freehold capacity rights, which are traded, and there's a value attributed to those. And those values have been reasonably steady. They have the funds at Lloyd's, the capital in those companies, which you can see what they are, and that's lodged in Lloyd's, and we buy that with the company. And thirdly, you have the pipeline losses at the moment, is pipeline profits or losses, and we put a value to those. So they're relatively straightforward businesses to value. We make adjustments for tax, and then we like to buy these companies at a small discount. But given the prospects at the moment, maybe those discounts are going to narrow a bit.
Your other question was, I think, a really good one, and it would take at least another 15 minutes to give it justice. But whether we prioritize LLVs over increasing our retained, and it is complicated. I think I would say you have to take the tricks while they're available. And adjusting our retained in the quota share is available to us anytime. That's our behest, this year, next year, sometime never. The availability of LLVs to buy is now. And we are the only people, famous last words, doing this. And we, the first mover advantage, I think, is really quite considerable. And I guess that the LLV purchase game will largely be over in 3 years.
So we've got a number of questions from Miles, but I'm just going to deal with one now because unfortunately we don't have a chance to ask any more at the moment. Please discuss in a rising inflation interest rate environment how the following interact: rising costs of claim, higher income from invested premiums, and hits to NAV from marks to market.
Another good one, Arthur. Do you want to? Because I do remember inflation when it was really, really high some years ago. But Arthur, carry on. Yeah.
So a point to make clear is that the syndicate managers, so we are participating in business which is are substantial businesses, and they have their own management teams. And most of the funds that are managed or looked after on behalf of the capital providers are managed by those syndicate managers. And they are very aware of the risks of rising interest rates and the potential for losses on bond portfolios on that. They would have their own risk appetites, which is agreed at their board level. Nigel and I, you're looking at two out of the three employees at Helios Underwriting. We don't get involved in the management of the underlying businesses. We are merely passive capital providers. So being managers of risk, the risk is not only the underwriting risk in terms of claims, it is also the investment risk. And every single of those businesses are very aware of that. In terms of inflation and claims inflation, there's been lots of discussion in the insurance market about claims inflation and social inflation, particularly social inflation in the US. Again, it is the managers of the syndicates themselves who then have to assess the loss trends, the potential losses on their portfolio, and the likely premiums that they have to charge to cover those loss trends and whether they're going to make any money out of that business. Yes, it takes a few years for that to materialize as to whether they are or not making money. But with the recent rate increases, the comments are going, there is now rate adequacy in terms of both the inflation and social trends that they are experiencing at the moment.
Gentlemen, thank you very much indeed.
I hope you've all found this afternoon's event helpful. I'd like to thank all of our speakers for their contribution today, and you, the audience, for taking part in the forum, and thank you very much.